Argus Media, this is Driving Discussions, a podcast series focusing on the forces affecting North American road fuels. Greetings and salutations once again. Associate Editor of U.S. Products Jason Metko here, and on this particular presentation of the series, we catch up with what's been a busy time in the downstream market and refineries with our senior news correspondent Nathan Risser. Mr. Risser, welcome back. Hope you've had a good summer. I know it's been a unique summer in a lot of ways in the downstream sector. Tell us a little bit about what's been transitioning in the market the last few months.
Yeah, hey Jason, thanks for having me again. You summed it up. The last 2 to 3 months have been full of headwinds for the U.S. refining industry, and largely that's led to lower profits than last year. Chevron's CEO summed up the mood when he said this month on an earnings call that, quote, "We're back to pretty tough margins." So if we take a step back and look at the recent history, the U.S. downstream industry, refined product demand surged coming out of the COVID-19 pandemic, and then the war in Ukraine tightened markets in the Atlantic Basin. That was great news for refiners who ran their refineries hard and made bumper profits in what was a historically wide margin environment. But since the end of last year, and especially in the first half of this year, there's been a slow return to more normal profits driven by a combination of moderate demand and steady supply as refiners returned from a heavy spring maintenance season and ran their plants at high utilization rates.
So you've reported that refiners are now cutting their crude throughputs. Reasoning behind that would be what exactly?
Yeah, so it's really a response to a oversupplied refined products market this summer amid demand that, in the eyes of fuel makers and distributors, was disappointing. Refiners were hoping that resurgent post-COVID demand would continue its upward trend, and tighter capacity following plant shutdowns over the last 5 or so years would keep refining margins wide. A scenario like that would give refiners reason to run their assets in the mid to high 90% utilization range in peak demand periods like summer. But the demand levels to support those kind of rates didn't materialize in the peak U.S. driving season. And in the words of PBF's CEO on a recent earnings call, markets, he said, broke from their typical seasonal patterns. H.F. Sinclair, a fellow refiner's CEO, said on his company's earnings call that those high run rates coming out of the spring turnaround season were not sustainable. So as a result, U.S. refiners are planning to cut their crude runs in the third quarter. Valero, H.F. Sinclair, and PBF have all said they're planning to run lower throughputs in the third quarter compared to the same period last year and the second quarter of this year. Phillips 66 is cutting average utilization rates across its refineries to the low 90% range from 95% in the third quarter of last year and a whopping 98% in the second quarter of this year. Those are just the refineries that give throughput outlooks, but together they comprise about 6 million barrels a day of capacity, a third of the U.S. total.
He is our senior news correspondent, Nathan Risser. We're talking the downstream sector on this edition of Driving Discussions. So you've been on all these earnings calls with various refiners. What's the outlook for refined fuel use here, Nathan?
To put it simply, it's mixed. There are bright spots, notably distillates, such as jet fuel and diesel. Refiners have signaled that these fuels will be the likely growth areas in the future, but the outlook for gasoline, which is the most consumed U.S. road fuel at about 9 million barrels a day, is less rosy and has dragged down refiners' overall outlooks. Chevron's CEO Mike Wirth captured the mood well when he said on a recent earnings call that the overall demand outlook for refined products is, quote, decent. The big issue has been gasoline demand, which this summer came in lower than expected during peak summer driving season, and it looks increasingly likely that the 9.3 million barrels a day consumed annually from 2016 through 2019 will be the historic peak. It's an interesting situation because Americans are driving more than ever. The latest available annual vehicle miles traveled data shows that 2023 was a record year for miles traveled, but gasoline demand that year lagged 4% below 2018 and 2019 numbers. So this is a break from historical norms. For the last 50 years, there's been a near-perfect correlation between vehicle miles traveled and gasoline demand in the U.S. They both rise and fall with seasonal and economic factors, but that relationship is now fraying, and there's one main culprit: engine efficiency. Cars and trucks delivered for sale in the U.S. for the 2023 model year get an average 27 miles per gallon. That's 8% higher than 2019, before the pandemic, and 36% higher than the turn of the century, based on U.S. Environmental Protection Agency data. Those MPG numbers include EVs, gasoline electric hybrids, and plug-in hybrid electric vehicles, which comprised 25% of the vehicles produced for sale in the U.S. in 2023, which is up 6% from 2019. Of course, that's just the 2023 model year, and the overall US MPG includes many prior year models, but at the end of the day, increasingly efficient internal combustion engines and a growing share of electric vehicles on the road has meant that US drivers can drive the same amount of miles or more on fewer gallons of gasoline.
A couple more moments here with our guest, Nathan Risser, our senior news correspondent, on this edition of Driving Discussions. Kind of hard to believe that since the turn of the century, we're getting a third better gas mileage now on our vehicles. With this shift in demand, how are refiners reacting to all this, Nathan?
So one avenue for them is controlling costs. If you're facing narrow margins driven by lower demand and refined product prices, one of the levers you can pull is getting the costs of your inputs and the costs of your processing down. So on the crude side, refiners for many years have been retrofitting their plants to process heavier crudes. Valero and Marathon, for example, both did this down on the U.S. Gulf Coast with the aim of taking heavier South American grades, while refiners on the U.S. West Coast have recently been taking more Canadian heavy crude following the expansion of the Trans Mountain pipeline. It's a simple equation. If refiners can buy cheaper crude and sell refined products at the same price, their margins widen. But they also have to control the cost of processing those crude inputs. So that includes everything from labor costs to turnaround costs to catalyst costs. Across refiners on recent earnings calls, you heard them talking of cost discipline as a major focus for their companies. And so part of that has been a focus on debottlenecking operations at existing refineries so that plants can run more efficiently. And for others, it has meant cutting and selling non-core assets. So Phillips 66, for example, has been divesting non-core assets such as parts of its European retail business and U.S. midstream business. Smaller refiner Delek recently sold its gas station and convenience store chain. Another way to cushion the blow of lower or flatlining domestic demand is exports. Refiners with Atlantic Coast and Gulf Coast plants have easy access to export markets to Europe that can help make up for lackluster demand in the U.S. This is part of the reason why two of Citgo's Gulf Coast refineries that are currently up for sale in Texas and Louisiana are particularly attractive assets for a buyer who wants to access a busy export market and an import market for cheaper crudes. The auction process for those Citgo's assets is underway, with a buyer expected to be announced by the end of the year. It wouldn't be a surprise if a landlocked refiner wanting access to the Gulf of Mexico emerged as a top bidder.
Certainly interesting times. Nathan, as always, we appreciate it, man. We'll talk again soon.
Thanks for having me.
He's our senior news correspondent, Nathan Risser. And with that, we put yet another bow on an edition of Driving Discussions, a production of Argus Media, a leading independent provider of commodity and pricing information. Friendly reminder to check out the previous episodes in our series. And for more details on Argus's U.S. products coverage, make sure you visit argusmedia.com/US-products.